All right, welcome back to another episode of the Black Bullion Show for goldandsilvertoday.com. Check that website out, everybody. Okay, so today is going to be a chart heavy day. And guys, I actually just want to give you a quick disclaimer, quick housekeeping. I'm actually going to be switching up the uploading frequency for this channel just to test something out. So instead of 3 videos a day, we're going to shorten it to just one video a day and pack as much information as we can within about 10 minutes or so of content. So without further ado, let's talk about gold and silver. Okay, so here we have gold on the year-to-day daily chart. As we've been acutely aware of this for some time, the 50-day moving average has been closing in on the 100-day moving average. Slowly but surely. A couple of weeks ago, the 50-day was at 1940 an ounce. Now it slipped down to 1924, and it looks like 66, 67. Looks like it's oscillating between an ounce. Now the 100-day moving average also moved up slightly by $1 recently to 1872 from 1871. And looks like it's about to hit to 1873. So why is this a potential problem? Well, the 100-day moving average represents medium-term sentiment, while the 50-day represents near-term sentiment. So if the 50-day dips below the 100-day, there's likely a chance of a near-term drop in price. And guys, this is what some people might refer to as a death cross, especially when it crosses, when the 50-day crosses into the 200-day. Now, this isn't too surprising, as we've been seeing, some consolidation, and the shape of the consolidation looks, not good as far as near-term prices are concerned, but it depends on your outlook, because it could be a buying opportunity for you. And guys, actually don't think this is just gold here. Silver also has, to contend with the same thing. As you can see here, silver's 50-day moving average has now dipped to 25.67, and it was just at 25.99 just about a week or so ago. So that's pretty wild. And now we're also going to do something a little bit different here, because I usually tend to focus on gold and silver with moving averages. Now we're going to look at the gold to silver ratio with these moving averages. Same thing, 200 and 150-day moving averages. Now, the 200-day moving average is still firmly placed above the price action and above the near-term averages. Now, this is a good thing, guys, because when the 200-day moving average is above in the gold to silver ratio, we want that ratio to continue going down, right? So we want that 200-day moving average to be above everything else. It's just a good sign for the long term with continued downside movement in the ratio. But of course, with near term sentiment, take a look at the 50-day. Right at the bottom, it's that blue line there right below the price action. It looks like it's beginning to coil up a little bit, and it looks like maybe it wants to head into the direction of the 100-day, which is the green line there. So what that tells me is that in the near term, it looks like we may have the possibility of the gold to silver ratio, or better yet, I should say silver to gold ratio, moving up just slightly from where it is right now. So as far as gold and silver prices are concerned, silver may actually drop a bit more in percentage when those averages cross. So, with all of this, believe it or not, all of this, potential downside movement in gold and silver prices, it's not happening and not existing within a silo, guys. And this is also something that I want to start packing into these videos a bit more. We're going to be talking about the overall markets in general. So let's take a look at what a lot of people tend to look at here in the US, which is the Dow Jones Industrial Average. Now, this is a bullion channel, but I want to showcase this because there's a lot that we can kind of glean from the overall direction of the general market and see where gold and silver may be heading. So we're actually going to be talking about two concepts right now. The first concept is called institutional distribution, and the second concept is called overhead supply. So we'll be talking about this, referring to the U.S. major indices, and then also some particular stocks that are heavily weighted within these indices. Okay, so if you've been following the Dow, the S&P 500, the NASDAQ, you may have noticed that in recent times, some traders have pointed to a cup with handle pattern forming, or better yet, a double bottom with a handle, which looks like it's more appropriate here. As you can see, it has here's the top side, looks like a W, comes down, goes up, down lower, and then goes back up, and then forms a little bit of a handle here. This looks more like a double bottom with a handle. So with that, what I'm currently seeing is somewhat concerning in this weekly year-to-date chart of the Dow. Now, the reason why is on the left-hand side of the double bottom on the week of August 26th, the volume here, as you can see at the bottom in that green flag there, is the volume was at 2.04 billion at a price level of, in the black flag there, at 28,645.66. Okay, but on the right hand side, we're actually at a higher price level at 28,679.81, and the volume was at 1.99 billion. So according to Dow theory, anytime you see price levels rise while volume is decreasing, be very skeptical about any upward movement that could come. And generally, since pretty much the start of the Ronies here, you see this bottom here, and since the start of the Ronies, we've actually been seeing diminished volume as the price level tries to get back up to where it once was before the Ronies. As you can see here, we had a lot of volume here, and it just slowly, it's very, very slowly, it's sometimes kind of hard to see at times, but it's generally been slowly trending down as the price level has been rapidly heading up. And we'll be talking about some other things in other videos to come this week about also why I think things are getting a little bit toppy here. If you guys have heard of these different stage bases, we're going to be talking about third stage bases and fourth stage bases and all of that stuff as well. But again, what I believe we've been seeing in recent weeks has been spurred by a concept called institutional distribution, i.e. the fat cats on Wall Street basically selling positions so they don't get caught holding the bag at the end. And it's not just the major indexes that you'll find the strange behavior. Here we have Amazon, and again, a highly weighted equity in the S&P 500. It's struggling to get above 3,500 where it was here at September 2nd. It's struggling to get back to where it once was. It got up to about 33,440 and then started to come down a bit, as you can see here. And in recent days, we've been finding actually many tech stocks opening high while finishing the day lower. Now, that's a bad trend, especially since Amazon, Apple, and Facebook and others are highly weighted in these major US indices. Let's also take a look at Apple here. The trouble with many of these tech stocks, getting above their recent highs, it can be traced back to a concept called overhead supply. Basically think of overhead supply as a psychological level where traders, who got in a little bit too late before the last major run up. So this run up right here, let's say, for example, they got in like a little bit beforehand, because they're starting to see that things are getting a little bit toppy and they just want to break even. Anytime they start to get a run up closer to this area, they just start selling because they just want to break even. That's something that I believe we're starting to see. And again, I think a lot of this is being led by institutional distribution. I think that most people who are in the stock market, who are retail or just individual investors, they're probably not doing this at all. They're just holding on and they're not selling. But those who are traders, they just want to break even, likely right now. And again, there's a reason why I say this when it comes to these bases that we've been seeing this year. But again, I'll talk about that later. So bringing this all back home to gold and silver prices, let's scoot all the way back up. You may find that today's price levels in both metals to be promising. But what I believe will happen in the near future is that the overall market will suffer, not just gold and silver prices, but the overall market. And what I tend to like to do, just as a quick measure on the day, is just take a look at how the VIX is behaving from time to time and just monitor it. If it goes up, likely we're going to be seeing equities and other stocks fall a little bit. We'll see the dollar rise a little bit as well. But as far as today is concerned, gold and silver remain range bound. Again, things are moving tighter and tighter within this range. Again, with the 50-day almost acting like a resistance level and the 100-day acting like a support level. So we're just moving tighter and tighter within this range, and eventually it will break. And I think what will happen is we'll likely break to the downside, but this won't just be gold and silver. It'll be market wide. But guys, let me know what you think in the comment section below. Thanks again for watching. Please hit that like button. Please subscribe if you're new. It's Black Bullion for goldandsilvertoday.com.